Hey everyone, welcome back to the channel. For decades, US Treasuries have been the gold standard, considered the safest investment in the world. But something's changing. Foreign investors are stepping back, yields are hitting 20-year highs, and some headlines are now questioning something that once seemed untouchable: the US dollar's status as the world's reserve currency. So what's really going on? Is this just short-term market noise or a signal of deeper trouble ahead? Let's break it down, with clear facts and context. The shift we're seeing: first off, foreign demand for US Treasuries is declining. At the May 2025 30-year bond auction, foreign participation hit its lowest level since 2019. As a result, yields have spiked. The 30-year Treasury recently reached 5.15%, the highest in nearly 2 decades. This means investors are more nervous and are demanding higher returns. On top of that, Moody's downgraded the US credit rating from AAA to A1, citing rising debt and unsustainable interest payments. Meanwhile, the US dollar index is down more than 5% this year, a sign that global confidence in the dollar is starting to waver. And here's a striking stat: for the first time in modern history, the US is spending more on interest payments than on national defense. That's not business as usual. Something bigger may be happening here. What's driving this? Let's look at the root causes. The US national debt has soared past $36 trillion, and the deficit keeps growing due to ongoing tax cuts and spending increases. Some projections suggest the US could hit a debt-to-GDP ratio of 200% by 2055. This isn't just a big number, it has major economic implications. Research from economists Carmen Reinhardt and Kenneth Rogoff shows that when a country's debt exceeds 150% of GDP, long-term growth slows, investor confidence weakens, and governments have less flexibility to respond to crises. Now, some people point to Japan, which already has a debt-to-GDP ratio over 200%. But Japan is a unique case. The majority of their debt is held by domestic institutions. The US, however, depends much more on foreign investors, making it vulnerable if confidence starts to fade. Interest rates and the financial illusion: we're also in a higher interest rate environment, and it's likely to stay that way for a while. That means it's getting more expensive for the government to borrow money. Investors are demanding higher yields to offset the growing risk. Back when rates were low, the true cost of debt was hidden, what economists call a financial illusion. Now, that illusion is breaking. Each new dollar of debt costs more to service, and that's quickly piling up. To make matters worse, as older debt matures, the government has to refinance it at these higher rates, squeezing budgets even tighter and leaving less room for things like stimulus or emergency spending. Global trust is eroding. Trust in US fiscal stability isn't what it used to be. Political gridlock, debt ceiling drama, and ballooning deficits are prompting foreign investors to hedge their bets. We're not seeing a total exit, but there's definitely a reallocation happening. Some investors are shifting away from long-term treasuries, while others are diversifying into other currencies or bonds from more fiscally stable countries like Germany or Australia, even if those yields are lower. The message is clear: US debt is no longer seen as a guaranteed safe bet. Why this matters to you? So, how does this affect everyday people? Rising yields equals higher borrowing costs. Mortgage rates, auto loans, and credit card APRs are all climbing. That's a big deal if you're buying a home or refinancing. More debt equals less room in the federal budget. As interest payments eat up more of the pie, there's less left for healthcare, education, infrastructure, and other services. Bondholders are feeling the pain. If you hold long-term bonds, you're seeing those values drop as yields rise. For example, if you've got $500,000 in long-term bonds and rates go from 3% to 5%, your portfolio could lose 15 to 20% in market value, even if the income stays the same. Weakening dollar equals higher prices. A weaker dollar makes imports more expensive. Everything from electronics to clothes to groceries can go up in price, contributing to inflation. A silver lining? There is one upside. Savers are finally earning real returns again. High-yield savings accounts, money market funds, and short-term treasuries are offering 4 to 5% returns. That's a far cry from the near-zero interest rates after 2008. But remember, it's not just about the nominal rate. What matters is the real return, or the return after inflation. If inflation is 3.5% and you're earning 5%, your real return is 1.5%. But if inflation rises to 6%, your 5% yield is actually losing ground. A wake-up call. This is about more than just interest rates or headlines. It's about fiscal credibility. And for the first time in a long time, the world is asking, what happens if the US loses its blank check status? Now, to be fair, there are strong counter-arguments. US Treasuries are still among the safest assets on the planet. The dollar's weakness may just be part of a normal cycle. Some foreign investors are shifting to short-term bonds, not exiting altogether. Rising yields could actually bring new buyers into the market. And let's not forget, the US still has the largest economy in the world. The risks are real, but they're also factored into current prices. Still, this moment should serve as a wake-up call. The game may be changing. The question is, will US leaders rise to the challenge? Call to action. What do you think? Is the US still the safest place to park global capital? Drop your thoughts in the comments below. I'd love to hear your take. If you found this video helpful, give it a like. If you're new here, consider subscribing for weekly insights. And if you know someone who might benefit from this information, feel free to share it with them. Thanks for watching, and I'll see you next time.